I think you have to be very disciplined in public markets. But I think it's actually a better market because you have a lot more information. And the reality is, so many things trade below their last private round at one point or another, and you're liquid, right? We kind of divide the world into two paradigms. Like one is fundamental paradigm, which is you buy an asset because you want to hold the asset. The other one is kind of what TradFi calls greater fool theory, which is you want to sell it to somebody else.
Nothing said on 0x Research is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are solely our opinions, not financial advice. Boccaccio, Ryan, and our guests may hold positions in the companies, funds, or projects discussed. What's up, guys? Welcome back to another episode of 0x Research. Today I'm joined by Dan Smith from the Blockworks Research team and Noah and Felipe from the investment team over at Theia.
Good to be
Thanks
here,
for
guys.
joining, guys.
Thank you. It's a favorite podcast of ours, so we're happy to be on.
Happy to hear that. I guess before we get started, do you guys want to give a short introduction of yourselves, how you got started in the space, and a bit about Theia?
Yeah, absolutely. Yeah, maybe I'll give you the intro on Theia first. That's the more important thing. So Theia is a liquid token fund primarily focused on long-term investments with teams building on-chain financial primitives. We actually operate our fund completely on-chain as well, just to dog food the industry. We're a team of three with backgrounds in private investing. We run an activist strategy focused on fundamentals. That means we usually underwrite to a model, a 3-year model on an underlying business, and work closely with teams to kind of achieve that model and underwriting outcome. We run a pretty concentrated book, fewer than 15 positions, and the idea is to focus plenty of hard work and attention on each of our portfolio companies. So we work with teams on things like token design, business development, research, financial design, and what we call banker work. I think our goal is to be the best liquid holder in the market. You probably know a lot of our portfolio companies. They include names like Banana Gun, Vertex, Lyra, Euler, Houdini Swap, Metaplex Camino, and a few others. Maybe background on me, before Theia, I did 7 years in kind of private equity, mid-market private equity in the U.S. Not at all related to the space, just kind of doing buyouts in healthcare, industrials, financial services. The content wasn't related, but the strategy is essentially the same. We're running a mid-market private equity strategy in liquid tokens.
Yeah, my background, I started trading crypto as a hobbyist back in high school, and then after graduating college, joined a venture capital firm in the space called Verify Capital, and worked on the investment team for a few years before joining Theia.
Fantastic. So you guys mainly do liquid tokens on the public market. I guess I kind of want to understand like how you guys view that market as like why you exclusively focus on that. Number one, and number two is, do you think public market participants kind of get the bad end of the deal compared to private markets?
Good question. So the first answer is easier, which is there's a lot less competition in liquid, and there has been historically. So a lot of really smart VC funds, when we started in early 22, it was almost an impossible market to penetrate, really, if you weren't well connected in the space and didn't already know what you were doing. Liquid, one was much less competitive at the time, and then 90% of the firms in liquid burned down, so it became even less competitive. And now there's kind of only a few handful of firms really operating on the liquid side. The second thing is that's where the fundamentals are. So we're really fundamental investors. We like to think about revenue, cash flows, kind of post product market fit investors, and that really happens, on the liquid markets here.
And what about compared to private markets, like the public market? You said that it's less competitive in public markets, but do you think it's, easier for private markets?
Yeah, you asked if we got the wrong end of the stick. I like where we play. I think you have to be very disciplined in public markets, but I think it's actually a better market because you have a lot more information, and the reality is, so many things trade below their last private round at one point or another, and you're liquid, right? So I think maybe this goes to like one of our higher level fund theses. You know, the idea of investing in fundamentals is controversial in the space. Dan and I have actually spoken about this many times over the past like year or so. We kind of divide the world into two paradigms. Like one is fundamental paradigm, which is You buy an asset because you want to hold the asset. You want to back the team over many years. You want to get the dividends, benefit from the buybacks. And if the market shut down, you'd be happy holding that asset. The other one is kind of what TradFi calls greater fool theory, which is you want to sell it to somebody else. But I think in this space, we call it like periodic bubble theory. Because the reason people buy these assets is because they think that every 4 years there is just a bubble where everything inflates, and the only thing that matters in that kind of paradigm is holding exciting narrative assets. So things like revenue fundamentals don't matter at all. What matters is what are what is the priesthood talking about in the space, what's exciting, and those things will, the theory goes, trade hundreds of times above intrinsic value. We don't buy that at all. We think that happened twice and it's not going to happen again. We actually view the industry not like it's the post 2017 Ethereum, where we're kind of gearing up for another bubble, but like it's post 2001 Silicon Valley. So in 2001, we had something like what happened here in 2020, 2021. And everything inflated out of proportion. People were looking at price to clicks, price to eyeballs on names like Yahoo, Pets.com. Things traded at valuations they wouldn't see for 10 years. Then after that, what paid wasn't hoping for that to happen again, which I think is the equivalent of what's happening in CT right now. Everyone's hoping for 2020, 2021 to come back. What paid was saying, all right, so that burst. Let's get back to fundamentals. Let's think about first principles and what companies here are going to actually be able to generate moats and economies of scale and revenues and cash flows. And if you did that, you caught Google and Apple and Amazon, right? Instead of waiting for your Pets.com investment to come back. So that's a long way of saying, I think if you're just buying the supply chain, like you buy new token launches, you're going to get smoked because people are still launching tokens at valuations that are far above intrinsic value. But if you're patient, you pick your spots, you kind of do a few investments a year, you can get really, really good deals on the public markets. Noah, anything to add there?
Yeah, to address your point on do public investors get the short end of the stick? I think it depends on how you're viewing the liquid token landscape. I think if you're using a narrative lens, then the answer is probably no, because you're focused on the token going up as opposed to the characteristics or fundamental characteristics of the token. But for us as fundamental investors, I definitely think that there is some degree of adverse selection in public markets. And part of this is just a function of there being limited regulatory clarity. A lot of the businesses or protocols that we're looking to invest in, we hope down the line have the ability to generate cash flows. And we expect those cash flows to be given back to token holders. But generally, many tokens or many projects before the launch tokens structure their raises with safes plus token warrants. So they're raising equity and token. And so as a venture investor, typically there is this divergence in incentives compared to public market investors, where there's this question or where you benefit from value going to equity and token as opposed to value going purely to token. So I think the short end of the stick for liquid investors today is less clarity around whether an equity entity will accrue value or whether a token will accrue value. And for that reason, generally, when we're speaking with teams and doing our research prior to making investments, we're paying attention to, has the team raised from the equity entity in the past? How is the team being incentivized and things along these lines? That way, although we don't have this contractual obligation for cash flows to be paid back to token holders, we do understand where the incentives of insiders are relative to public investors.
That's a really interesting point there, Noah, and I want to expand on it a bit. So have you seen a historical change in the split between these like token only teams versus token and equity teams? Like how has that changed through time?
Yeah, so I would say in 2020 to 2021, venture deals were almost entirely raised via SAFT. So pure token offerings to venture investors. And then I think that towards the end of the bull market, beginning of the bear market, call it 2022, we started to see safes plus token warrants become a bit more popular. And certainly by the end of 2022, it was one of the main ways that people were raising capital is via token plus equity. And I think the main reason why that change occurred was because a lot of investors that invested via SAFT started to realize some of the downsides of legal protections of SAFs during the bear market, when there were a number of teams that didn't deliver products but had capital and realistically should have returned that capital to investors, but investors did not have the capabilities to really claw back the capital. And so I think it was mostly a function of negotiating leverage change, as well as venture investors wanting to have more legal protections before a token goes live. Perhaps now that the market, or I guess in the end of 2023, we definitely saw a bit more SAFs come back into market. But certainly I would say that the majority of raises that are taking place still are with SAFE plus token warrant. So I think that's where things kind of stand today. I think long term, there will have to be this new structure that's created that is a bit more fair for all market participants. But I don't think that that conversation is really taking place between public investors and private investors to warrant finding out what that equilibrium is.
Yeah, but I will say there has been a trend towards more clarity around token versus equity at the public market side, because public investors are no longer accepting, these splits. So I think what Uniswap did with the front end, for example, they can get away with that because Uniswap is kind of a market darling. It's in a league of its own. But if you saw $100 million, $200 million market cap token do that, I think it'd probably fall substantially within the first few days of announcing. And I'm talking about the fact that Uniswap is sending front end fees to an equity entity as opposed to a token. I don't think tokens can get away with that anymore. They were able to get away with that in 2020, 2021. But look at market investors. We kind of all agree that that's a red line for us. That if a token crosses it, it's very hard for us to want to own it.
Okay, that's really interesting perspective. And then it's like, just to maybe contextualize this for the audience in like a very simplistic way. Let's say we had like Protocol A, and they raised a Series A, or let's say Protocol 1, and they raise a Series A, and it comes with a SAFE, so a simple agreement for equity plus this token warrant. When those investors execute that token warrant, like what happens to that equity side? Like, let's say every investor executed the warrant. Like, does the equity side still exist? Or is everything converted into this token?
So generally, the equity exists. There have been, in a few rare circumstances, that when a token is launched, the team will terminate the SAFE prior to converting into priced equity. Many times there will not be a conversion from SAFE into priced equity, but the SAFE will still exist. So I think it's very much case dependent, but certainly after a token warrant is converted into a token, the equity still exists most of the time. It would be completely up to the team to make the decision to remove the need for the equity. But I think as venture investors, you still would want to have equity exposure so that you can impart some of your legal protections if needed.
And how do you think about the divergence between the team needing, like the labs entity needing to sustain runway to continue operation, continue paying their team a salary, versus like the push and pull between token holders kind of demanding a return on their capital? Like maybe it's a little harder with like the Uniswap example, just because they've been around for so long, they're pretty well sustained. But like for that example, right? Like, they're going through this huge legal battle. So they turn on this front end fee in the same day that they got the Wells notice. And so presumably one could say, okay, well, they're making a couple $1 million a year, tens of millions of dollars a year. And they're using this presumably to fight this legal battle. Like, how do you think about the dynamic there between when you return cash flows back to the token?
Yeah, and then maybe this is actually one of the things we get a lot, talking about fundamentals and cash flows. And I kind of see it as a misconception in the market, because fundamental investors don't need you to return capital to them at all. They just need to know the capital is theirs. So like Amazon's had one of the best runs in kind of stock history based on what I would consider fundamentals, but they haven't returned a penny of cash flow, right? Or bought back a penny of shares. But the shareholders of Amazon know that those revenues correspond to, that they own those revenues as stockholders in Amazon. So that's all we need as fundamental investors. We We need the capital to go to some kind of DAO that's controlled by the token, or even just the assurance by the team that the cash flow belongs to the token. Then you get into capital allocation, right? Is it better for the team to keep that cash in house and use it to grow, to defend themselves in a legal battle? Is it better for them to buy back shares, to pay dividends? I think in most cases it's better for the team to keep the cash and grow, right? We don't want the capital back if you're still growing. We just want to know the capital belongs to the token and that the team thinks of it that way, because then we can build a model. What you're trying to avoid is the idea of building a model and then finding out that there's some other entity that gets to keep the cash and kind of getting rugged, so to speak, on the token side.
Yeah, I think that makes a lot of sense. And one thing you brought up is that you'd rather see the team keep the cash just to grow. And this is something we've talked about internally a lot, is that a lot of these companies are very, very early stage and growth companies. But I feel like a lot of CT or in general, like investors, look at Uniswap and say, hey, why don't you just return some fees? Do you want to, I guess, kind of talk about that and expand on when you think like Uniswap would stop being a high growth company and when it would start being like, hey, let's actually return some of our fees, or maybe not Uniswap, but in general, let's say Project One, like Daniel said.
In general, as long as the team, this is like a frequent debate in kind of TradFi, but in general, as long as the team thinks they have a high return investment to make, they should make that investment. And like high return, is defined by the hurdle rate of the investors. So anything above 20-30% IRR should be good. And like if you're in a growing industry and you're a team and you have somebody higher that you think is value add, that's probably the best use of capital, because almost anything you can do, provided the industry works out and the thesis in the industry works out, almost everything you can do that you think is value add as a kind of a responsible CEO of a project will be value add. So I think we tend to defer to the team on their, that you return capital when you're the management team and you say, I don't have a good use for this. So instead of hiring somebody or building out a V3, I'm going to go spend it on a token 2049 project, a party. At that point, maybe that's capital you should be returning. But anything where it's growing the team or kind of part of a good faith mission to grow the company, I think we tend to defer to the team on keeping that and using it for their best and highest use.
Hey guys, Permissionless, the event for crypto natives, is heading west to Salt Lake City, and we're bringing the biggest names in crypto together for an incredible can't miss event. Join me and the rest of Blockworks on October 9th to hear from more than 200 industry titans, including Nick White from Celestia, Firam from Eigenlayer, and Keone from Monad. The conversations at Permissionless will be covering the hottest themes in crypto, including modularity, restaking, the Bitcoin and Solana ecosystems, AI and crypto, rollups, L2s, institutional adoption, and of course the November election that will be right around the corner. We couldn't be more excited about this event, and it's happening in one of the most beautiful places in the US. Ticket prices will be increasing towards the end of June, so get your ticket today. Make sure to use the code so I get some credit and bragging rights from the rest of the team. Use 0x10 for 10% off on your ticket. One more thing. We're also hosting the Permissionless III Hackathon in collaboration with BiddleBox. The theme this year is a multi-chain future, to build a better cross-chain experience so I don't have to have a heart attack every time I bridge to a new chain. All hackathon participants will receive a free ticket to attend Permissionless. So if you're a developer, come join us in Salt Lake City, team up with fellow devs, and build the multi-chain future. I want to go back to your point on fundamentals and valuation. And I want to start off by asking, at what point do you view some of these, and like you guys said, you're fundamental investors, but some of these things are and potentially should be valued as growth stuff, like Celestia and stuff. Do you think that they need to come down a hell of a lot more, like another 90% on top of whatever 80% has already been down? Or do you just say, we're not going to look at these at all, I only care about stuff that has PMF?
Yeah, and I think Celestia has PMF, but yeah, Celestia's in the too hard bucket. Like there's not a model that we can write. There's not a good faith model that we can build to justify its valuation. So we're just gonna leave that alone. We're not long. We're not short. It's just out of our scope. And I think this is the other kind of what we call like fundamental misconceptions in the market. So one is, do you need to return capital? The answer I think is firmly no. The second is this kind of distinction between fundamentals and growth. fundamental just means you have a model, right? We call it like a good faith model. Can you point to a model that says, here's the valuation, here's why, and if you can, then it's a fundamental investment. I might disagree with you on the assumptions or predictions. You might say that, you know, your DEX is going to grow 400% a year for the next 5 years and end up taking up, 10% of global financial transactions. If you say that, that's fine. That's a fundamental investment in my mind. Then we can talk about assumptions. Where we think that the industry is kind of still needs to mature is on the idea of just not having a model at all and just trading purely based on narrative.
So I completely agree, first and foremost, and love the perspective. And it's funny to think that that's like not the base case for investment decisions in this industry today. But when you think about it's like blockchains have applications which look a lot like businesses built on top of them, and you can run these models and they look a lot like TradFi because the businesses look a lot like TradFi. But when we think about L1s, it gets a little bit more gray, at least in the discussion. So I'm curious about how you contextualize, like, you said you put Celestia kind of in that bucket off to the side. It's like, look, we can't run a model on this that makes sense. But what about, let's say, Ethereum or Solana or one of these other large base layers? Like, how do you conceptualize a valuation model for like one of these base layer L1s?
I'm happy to take a stab there. I'll start by saying I don't think that there's a clear valuation model to be used for L1s. There are a number of ones that you could attempt to use, but I don't think there's been one that's been agreed upon. I think that there's been discussion around like equating tips plus MEV and backing into the present value of that as like cash flows and valuing this business. I think that's one potential way of going about it. I think the other kind of line of logic is to think about L1s or some of these like base layer infrastructure tokens as emerging market currencies. As far as they grow with their usage, and most people own the token to use the underlying application or speculate on its future usage. And so my personal view is that like true valuation probably conforms more towards the latter model as opposed to the former model, and that I do think that it's very difficult to build out a fundamental valuation for an L1 that is attempting to minimize the MEV as well as cost of usage while also maximizing its revenue. Those two ideas are opposed to one another, and so you really just can't have a model that does both simultaneously and does both well. Either the network is low fee and people can use it, or it's high fee, in which case maybe it's valuable. But I think neither of those is necessarily logically true. In the case of an emerging market currency, I think that this is probably the more fair way of modeling these assets, albeit I don't think that we have a great way of going from saying this is a potential currency into what is the currency worth, just because it functions very differently from a traditional emerging market currency, primarily on the supply side. And like a traditional emerging market currency, as the demand of the asset grows, the supply would grow as well, which would limit like upside price reflexivity. Whereas in the case of like L1s today, typically the supply side is relatively fixed issuance, in which case, as more demand emerges for the currency, it goes up in value, which then creates this speculative interest around it and more reflexivity upwards. And so that's kind of like a long way of saying, I don't think that there's a great way to model L1s, and ultimately think that the way that the market's currently thinking about them is probably incorrect. So I don't know if you have anything to add there, Felipe, but that's at a high level, I think.
No, I used to love this two-shar idea on valuing L1s on MEV, just because it kind of brought things to cash flow and where I understand things. But the model doesn't work. Like Solana right now has way too much MEV. People are getting sandwiched left and right. Does your model say that ending that, like solving that problem will bring the value of Solana down? Right? Of course not. Or like, does your model say that creating, better sex to dex arbitrage designs that have less, better LVR parameters for LPs and create less MEV lowers the value of the L1? Of course not. So like, I think that model just fails the kind of basic test of telling you whether a decision is good or bad for the token. So So I think we are kind of in emerging market currency, best case, worst case, L1s are just all meme coins.
Yeah, that's the other thing that I'd add. If we use the MEV framework to value the L1, my sense is that the intrinsic value is going to be an incredibly low number. Call it less than $1 billion. Maybe it's bigger than that, but it's certainly less than 10 billion. And again, if we use the emerging market currency example, then there are a number of like negative economic principles with how like these tokens are designed that would make them not particularly good currencies, just primarily due to the underlying reflexivity of the currency. And so I do think at the end of the day, we have to ask the question, if these tokens are designed to provide economic security and the intrinsic value of these tokens is worth much less than the total amount of assets being secured on the network, do these tokens fundamentally work? And I think today that question isn't talked about as much because these tokens trade at astronomical values. And in the grand scheme of things, we still have very limited usage of L1 blockchains with less than 1 million concurrent users. But if you do believe that these L1 blockchains are going to back the global financial system and simultaneously be worth something based on like quote unquote intrinsic value, then there's going to be this large dispersion between what the token's security is versus what it needs to secure that makes it somewhat incompatible with the goal that it's trying to solve. So I guess that's a somewhat long-winded answer to say that I'm not sure that L1's tokens in their current form are kind of how they should look in the long term, as well as like whether the L1 that proliferates globally will have a token, and if it does, whether the token will exist in the kind of way that we think about tokens today.
You brought up the Solana example there, which I think is really, really interesting because Solana was the first chain to really prove that the idea that you can have a meaningful amount of total transaction fees with a very low median fee, right? It does about 800 TPS on an average day, and we still see a median fee that is well below 1 cent, somewhere around, let's call it 0.2 of a cent. And so that annualizes out over the past couple quarters now to about 500 million in fees. And then you also mentioned the MEV aspect there. And like, let's say a hypothetical here. Maybe we take Solana out of the idea that this chain is Solana out of the equation and say, okay, so let's say you have 500 million in transaction fees, and another 500 million in this like out of protocol tipping mechanism that, we call them MEV tips, but it can really be used for anything. And it kind of just gives you an ability to pay the current leader, hey, I just really want this transaction to land like immediately. Like, here's a little bit of extra, I'm like, let's say I'm doubling my transaction fee from 0.2 of a cent to 0.4 of a cent. I just want this thing to land. How do you like think about that angle where, let's say we do get $1 billion of annualized total transaction, total economic value between fees and MEV. You can start to get to like a pretty decent multiple from like maybe like a price to sales ratio if you were to consider that all as like top line revenue. I'm curious how you contextualize things there, because totally agree that, as an industry, I think we've all like woken up to the fact that there is a lot of malicious MEV. As for what percentage of that is, it's a little bit of a gray area because searchers are very good at hiding their activity to kind of make it very hard to run large scale aggregations and get like the total amount of sandwiching that's occurring. But point being, saying, let's say we reduce malicious MEV to 0. I still see a world where there will be an out of protocol or maybe an in protocol enshrined tipping mechanism that says, I just want this transaction to land immediately. And I'm curious if you think about that in a different light than like that malicious side of the MEV.
I guess so. Two points there. One, look, if you do get $1 billion of value going to validators, right? Then you can't put a multiple on that, and then it's kind of problem solved on the value accrual side. The question is whether that if is reasonable, and it could be. I think we're not L1 kind of traders, or it's not really the main business. We're just kind of thinking here. It could be. I guess the problems there are, one, there's competition between L1s, right? You have Max Resnick saying that you got to send MEV on ETH L1 to 0 for the benefit of the customers. And if one person does that, then the game theory is you have to do it as well if you're competing and you're all converging on designs, which is happening. So you have kind of the intra L1 competition layer where if one L1 lowers it, yours has to lower it as well, I guess, as long as you're kind of, all players still. And then you have the app kind of take rate as well. So we're seeing more and more applications take MEV from validators, right? So you have like Oracle extractable value is going to lenders and oracles. It's not going to validators. Or kind of, tips on Banana Gun and Telegram bots are going, I think eventually we think they go to the Telegram bot who controls the order flow, not to validators. So you kind of have that being eaten away at in both ends. On Solana, I think nobody thinks that number is all desirable, to your point. Then you kind of made the distinction between malicious MEV and benign MEV. Our view is there is no benign MEV. It always comes out of somebody, right? Like if you have a searcher taking a profit and having hard cash that they can use, that had to come from somebody. It was a tax on the system at some level. Maybe it resulted in wider spreads, on spot buys. Maybe it was wider spreads on perp buys. Maybe it was wider spreads on interest rates. So the borrower is paying more and the lender is getting less. And maybe it's LVR. But like you will find out that kind of benign MEV, quote unquote, came out of somebody's pocket, and it might be distributed across the system, or it might be one single person. But there's a conservation of value law, right? The searcher can't make money from nobody. So I think to some extent, if you are trying to make it the best financial system for kind of the core players, you always want to minimize MEV, no matter what you label it.
So would you disagree that, like, let's say cross-dex arbitrage, which would theoretically be bringing tighter spreads on chain, would still be viewed as like malicious MEV? Because maybe in that scenario, it's the LPs that are taking the hit.
But the LPs are a player, right? So you've been talking about LVR for years now. That's all kind of sex to dex or dex to dex MEV. But then if the LPs get worse returns, there's less capital on chain, there's wider spreads. There's always some economic story, just based on the first principle that money can't come from nowhere. So it's always a tax on somebody, and that tax will have secondary effects.
Yeah, I think your most salient point there was the idea that the applications kind of see this huge number that the L1s are generating off of their activity and saying, all right, like one way or another, we have to figure out how to internalize this for ourselves and ultimately our customers. And you've seen the idea of like app chains or DEXs are the ones that create and leak a lot of this MEV. So there's a whole world of DEX design around how do we prevent some of this. Ellipsis Labs and Paradigm recently authored a paper through Umbra Research, kind of like saying, all right, well, how about we design an AMM that theoretically could reduce the amount of sandwiching? Or you see Uniswap v4 on the horizon, and you could probably get some hooks that reduce this MEV leakage as well. So strongly agree. We're seeing a lot of innovation in that space around how to reduce the value leak down to the base layer.
Yeah, they'll figure it out. It's a big enough pie where they'll figure it out.
I want to bring it back to something you guys mentioned earlier on, which was activist investing. And I guess I just want to understand what the scope of that looks like in the context of applications. What does it exactly entail?
Yeah, so I think first of all, it's activist in a completely cooperative and friendly way. There's activists that kind of try to take funds from the DAO. We're not talking about that at all. We just mean kind of the basic blocking tackling that VCs do for private companies. Doesn't really exist much in the liquid space. So companies have a lot of support early on, kind of seed, Series A. They have a big cap table, a lot of people with big teams helping them out. And then you launch a token, you become kind of a prior fund investment, and the level of support you get goes down dramatically. So what we're seeing on the liquid markets is teams that, maybe had a couple teams helping them now have nobody helping them because they launched their token 2 years ago or 3 years ago. And maybe the token's down. In most cases it is if they launched 2 or 3 years ago. And just even basic BD help, basic kind of token design help, because obviously investors look at a lot more token designs than one single team. Just oftentimes just being kind of somebody that they can talk to every week about plans and go to market and bounce ideas off of. It doesn't take a lot to be helpful on the liquid token side because there's so few people trying to be helpful. Most people are just kind of demanding value or being a pain in the Discord.
That makes sense. Noah, do you have anything you want to add on?
Yeah, the thing that I would add is that during our diligence process, typically when we identify companies that we want to make investments into, we also identify 3 to 5 things that we think currently are not being fully optimized within the business, and attempt to address that after making our investment to help realize the underlying investments KPIs that we're underwriting to in our model 3 years down the line. So I would say that activist investing from our perspective is a way to realize the underlying model that we've built around the business over a 3 year period.
And what's the most common thing that you guys identify needs to be fixed? Like looking at all of your due diligence over the past year and a half, 2 years, what's been the thing that comes up the most?
Token design. There's a lot of variety in token design, and most of it's bad.
Yeah.
You know, there's different ways to design tokens. Like there are legitimate choices between, again, how much should you keep at the kind of company level? How much should you return? Should that be buybacks? Should it be dividends? There's legitimate questions, but then most of the time when you're kind of making some complex game theoretical token design, like that's a disaster. It doesn't really solve any problems. Or if you're like trying to give too much utility to your token, so like people with your token can do X and Y on the app and not Z. That never really works. There's been a lot of bad advice in token design. So, I mean, I don't. Yeah, there's been a lot of bad advice. So I think a lot of times it just kind of brings some common sense to the token.
No, token design definitely is the main thing that comes up. Also, because we're purely focused on investing in on-chain financial companies, I would say typically their customers or their highest quality customers are credit funds or like quote unquote whales within the crypto space. And so I would say intros to those funds as well as understanding how to pitch them is something that all of our portfolio companies generally could improve on or would benefit them from having kind of a good go to market within those groups of potential customers.
Yeah, actually, this is a good addition. It's like we call it banker work. It's like what your investment bank would do in traditional markets. Like sometimes it's telling people, what's your story? Like a lot of these companies don't know what their story is to investors. And at the end of the day, the ultimate holder in the market is the liquid fund. So your VCs invest in you privately, but they have to sell, right? They have to show DPI, and they have a legal end of fund requirement as well. They have to sell. Your retail holders can only do so much, realistically, especially like where the market is today. A lot of retail holders can make the price go up because it doesn't take a lot for prices to go up, given volumes are so low in the market. But they can't be holders because they just don't have enough buying power. So the ultimate holders are the liquid funds, and I think learning how to tell a story for a liquid fund buyer is something that a bank would do in traditional markets, but we end up doing for our portfolio companies a lot in these markets because obviously we're a liquid fund. We know how we think and how our peers think, and that can mean like showing the right metrics on the Dune dashboard. That can mean focusing on the right metrics and messaging your strategy in the right way, and that can mean just going out and doing a roadshow and meeting the right people who could be good holders. Because at the end of the day, people want to hold. People are looking for more investments. There's just not enough bankers in the space, believe it or not. I never thought I'd say that, but we need more bankers in this industry.
Going back to the token design piece you mentioned at up front, I agree with you that we see a lot of undue complexity in the token design category, and I'm curious if you think there's a bit of like a less is more mentality that makes a lot of sense there, where you don't necessarily need your token to do 150 different things. If we go back to the original point of if there is a strong likelihood that the cash flow that the business is generating will tie back to the token, like is that just enough?
Yeah, you have to. I think less is more is like the main conclusion of our work in token. I think if you're going to deviate from TradFi models, you have to have a good reason. So, there are good reasons. For example, Apple can't reward long-term shareholders more, but they don't have the pipes for it, right? But you can do that with tokens, right? You can decide to give some kind of increased stake weight to people who've been holding for longer or have been locked up for longer. You can introduce little mechanisms like that. I think around the edges can be good, but you're kind of like starting at the point of view that less is more. we're turning, treating this like a stock is kind of step one, and then how can we use the new technology that we have to make marginal improvements on this? That's kind of the right mentality in our view. And there are some things you can do, but there's just not as many as people thought.
Which that's kind of like a little bit backwards too. When you're scrolling crypto Twitter all day and you see people yelling about useless governance tokens. Do you think that in my view, that I think that narrative or that idea has really been created because we do have governance tokens over a lot of what are now like failed or dying protocols, because that's what we're going to see. This is a startup industry. You're going to see a ton of experimentation. When you fast forward that experimentation 3 to 5 years, okay, well, you're going to get a lot of failed businesses. And so that's why the governance token, if you will, kind of gets a bad rap, is because, well, there's just a lot of, businesses that didn't make it. I'm curious if you would agree with that idea.
I'm generally aligned, although I will say that I do think some of the sentiment around, or negative sentiment around governance tokens, is also a function of the belief of where cash would be allocated if the protocol was successful. Like for sure, I agree with you that there are a lot of like early stage startups that failed, and so their tokens are worthless. It doesn't matter kind of like what the underlying token can or cannot do. But for like the protocols that have succeeded and are generating cash flow, but that cash is going to an equity entity, let's say, I think that narrative around those being like quote unquote worthless governance tokens is totally valid, because in general they kind of are worthless, putting aside the value that you place on governance, because you don't believe long term that even if the business is successful, the cash would go to underlying business. Putting that aside, yes, I think in general, the governance tokens are probably a reasonable design at the current pace. Like I think at a high level, one thing that could be done that is almost always negative for token design is creating a complex structure that is very difficult to undo. Um, and in that, I don't think that a lot of the market is aware of like where tokens are going long term. And so locking yourself into like a V tokenomics model that has like a 4-year max lock is quite detrimental, because then you have to wait 4 years for that max locker to fully unlock before you can potentially upgrade the tokenomics. So I think like the worthless or like quote unquote like governance token model is relatively good because it's a very vanilla model that can be altered if needed.
I'll say one quick thing. I think sometimes we come across as like giving a lot of criticism to the practices of the industry, and that's coming from a very optimistic point of view. So I think at Theia, we're all believers in the industry. We think that the industry is going to go from 1 basis point of financial adoption to 70-80% over 20 or 30 years, and that's an incredible opportunity. So we're focused on getting people to stop playing games with narratives, playing games with token models, and kind of playing these PvP games and just focusing on, all right, you're a regular business with regular value accrual and value distribution mechanisms. Just focus on your core KPIs, focus on PMF, focus on your customer, and forget about all this gamification that we've kind of trapped ourselves into as an industry. So all of these critiques are coming at it because we are so optimistic about the kind of true opportunity here.
That makes sense. And I agree with both of you on the fact that it's unnecessary to have complex token structures. I think it's mostly just devs realizing that, not devs, but teams realizing that they can't really do much on for people to demand their tokens. So they just obfuscate away the supply side. It's like, oh, 4-year lock, nobody can sell, but there's always a seller. I guess on a more positive note, what are you guys looking forward to over the next year? We know the 20-30 year plan is 70 to 80% of the financial system, but over the next year or two, what are some things that you guys are focusing on?
Well, right now there is and has been a kind of quiet Moore's law in DeFi, and I think that's definitely underreported. But the reality is, when Uniswap launched, you're paying more than 50 bips to go ETH to USDT, and now you're doing that at less than 5 bips, right? When perps were 0% on chain, all on basically Binance and the other centralized exchanges 3 years ago, and now we're at 3.5. And 3.5 is not a big number, but it's a lot more than 0, right? And it's kind of going up every year. We think that this year we've seen options start to make headway on chain for the first time after a few failed experiments in the past years. Everything's getting better in DeFi, right? Like some of these Morpho, Euler, even Aave V4 are so much better than what we saw with Aave V1 and Compound V1. And that wasn't even 5 years ago, right? So, if you just zoom out and think about what's been achieved in DeFi over 5 years, it's incredible. So we're trying to play those trends where we just see costs going down, products getting better, on-chain taking share from off-chain, right? On-chain spot was 14% of the market last month. That's the highest number ever, and it's a really serious amount of volume going on-chain. So I think that is just like it's a quiet kind of renaissance in the market, and that's where most of our investments are.
Yeah, I would say in general, something Felipe briefly mentioned is focus on lending markets. I think that a lot of on-chain financial primitives have demonstrated product market fit. But when I think about the one that has demonstrated product market fit as clear differentiation relative to centralized players, I think that lending stands out a bit more than certain other market segments within on-chain finance. And I think in general, we're quite interested in seeing the advancement of kind of the Aave V3 and Compound V3 models to the next iteration. And that I do think like these pooled risk models generally are not great for experimentation, innovation within lending in their current form. Lending is done where any asset as a collateral or borrowing asset added to Aave or Compound adds risk to every other participant within that system. Whereas isolated markets create, albeit create more capital and efficiency, allow for risk mitigation across a broader set of assets. And so with Morpho, for example, starting to proliferate with Euler V2 launching in the next month or two and Aave V4 coming at, I think, the beginning of 2025, I think that we'll see a lot of experimentation. And then the last part within lending, besides kind of the isolated lending, is I think that Pendle has found some semblance of product market fit over the past year or so. And while Pendle in itself has been heavily focused on facilitating airdrop farming, I think one of the next advancements that comes from the usage of Pendle is more focused on fixed rates and floating rates as well as interest rate swaps. And so I think those products will continue to be built out and probably find some semblance of product market fit in 2025.
Yeah, I agree. I actually, Felipe, I want to ask you about options because this is something that I feel like has been tried, like you mentioned, and I want to understand what this, I guess, next step will be for it to actually be used on chain.
So so if you look at Lyra stats over the past 8 months, they're up only, and they're getting real usage. We've been tracking options for about 2 years. We made an investment in Lyra. We publicly announced in Q1 of this year. And the reason why consensus is that options don't work on chain is because AMMs don't work for options. And AMMs in general, like, were treated as a catch-all design for a while, but they actually only work for a few things. Not very few, but a few things. And trading with sophisticated market makers who are only trading with you because they have a positive EV trade is not one of them. And that's what happens when you try to do an options AMM. All of your flow is sophisticated flow, right? And then if you have anybody like us, an on-chain fund, trying to buy 40K of SOL options in 2023, true story, you're blowing out spreads by 30%. So we're just never going to do that, right? So I guess it's a long way of saying that option AMMs were not a real attempt, or they were a real attempt, but they were a failed attempt. But now we have the technology for order books. Lyra is an app chain, settles Theia on Celestia, built on the OP stack, but it's a full order book where market makers can get competitive technology to what they use on Deribit. And that means that you can get, if you have the taker demand, comparable spreads to Deribit with the benefits of being on chain. You have modularity, you have much faster product iteration, and most importantly, you have the ability to build structured products that now live within DeFi. So I think and that's become the structured products angle has become the main angle for kind of options to take share. So, I think most people, when they think about options, they think about competing with perps on levered trades, kind of 0 days. That's an interesting market. There are definitely advantages to options. The main one is you can't get liquidated. Like I would never buy a perp, but I would buy an option. And I say that as somebody who's, we're invested in perp protocols, but just my risk tolerance doesn't permit me to buy something where I can get liquidated on a wick. But more importantly, people love structured products in our space. There's a lot of whales. They have a lot of BTC, a lot of ETH, a lot of SOL, and they want to get yield on those things. And one of the best ways to get yield in TradFi in any market is with options, because without options, you just don't have convexity in your product design, and that just limits your design space materially. So that's what we're seeing options take off with order book backends and structured products on the front end to give people yield on TVL.
Daniel, do you have anything you want to?
Yeah,
Okay.
outside of DeFi, what are there any other verticals that you think are starting to kind of get some traction in that category of like building a real business on chain that looks and feels like a traditional business and ultimately generates cash flows?
Everything I give you will be DeFi adjacent. So we because that's how we think. So like Metaplex is one of our investments. That's NFTs and token mints. We see NFTs as DeFi really. Like I know that they've been kind of art collector for most of the use cases so far, but we think that most NFTs over time will be kind of financial applications, asset applications. But Metaplex is a great company, really fantastic company with a good team, strong cash flows, kind of everything that we look for. Front ends, again, kind of DeFi adjacent. We're investors in Banana Gun. Really like the Telegram bot space in general. You're dealing with super price inelastic customers, and you're giving them services that have pretty meaningful impact on their trading strategies, and those people are willing to pay you a lot more. So, I kind of we like that space for that reason. We like dealing with inelastic customers. Don't ever sell to funds as a kind of order flow business because we're tough customers, but the guy trading meme coins or trading 180 vol tokens is a much better customer when it comes to paying. And then not purely DeFi, but we're very excited about this on chain needs more bankers story. So we're kind of always working with people that we think of as kind of good providers from the industry. One company we're working with is called Turtle Club. Probably one of the more exciting ideas we've heard all year. They're basically a group purchasing organization for TVL. So they aggregated about $2 billion of whale TVL since they launched 4 months ago. They're actually generating, they'd be one of the major DeFi applications in terms of revenue if you kind of put them on the token terminal bar chart only 4 months in, which is quite impressive. And what they offer to protocols is that they're TVL bankers, right? Like we've seen our companies, try to get TVL by doing deals with whales and going out to market and doing points or incentive programs. And what ends up happening is that they have to start from scratch every time. So they have to say, they have to ask us and their other VCs for a list of people that deposit ETH or Bitcoin, to design a program, go pitch, get turned down. It's just a brutal process. And, again, looking at TradFi, the way that's been solved is you have capital markets bankers, right? You have people that say, I have a roster of 1,000 clients with this much capital, and let me work with you for 2 weeks setting up your program so it appeals to a subset of these people and you can meet your goals. And Turtle Club is doing that for protocols. So they're telling them, here's what we have in our client pipeline, here's what they want for yields. You can lower your BTC yields because they're actually low in the market right now, but raise your USD yields because Athena's paying pretty high, so it's not going to be competitive. Just giving advice and introducing people and going out to market, and that's been working fantastic, right? It's just it's not DeFi, it's not a protocol, right? But it's just kind of this idea of bankers and service providers just adding valuable services to on-chain protocols so that they can grow. No, anything to add? I said nothing that wasn't really close to DeFi.
Yeah, the only thing that I'll add primarily outside of DeFi is I am optimistic on DePIN. I think that it's not particularly in line with like quote unquote traditional business models, mostly as far as the token distribution to unlock supply side. But ultimately, it's probably the market that has started to show semblance of product market fit that some of these businesses have become modelable, because they do have existing customers, are generating over $1 million in revenue, and now are starting, in some cases, to eclipse the total amount of supply side and incentives that are being issued. So I think at a high level, DPIN models can work, albeit they have to mature to a point where the demand outstrips the supply. And just generally speaking, I think the industry is still quite immature, where there are probably like only 1 or 2 companies or protocols that that's true for. But over a 3 to 5 year time horizon, I'd imagine that that list grows pretty materially.
And Dan, I know you like this one. Future key and decision markets are awesome. Like, I think it's one of the coolest ideas on chain, and kind of like prediction markets. I think we could see it impact the real world relatively quickly if it takes off.
Yeah, I go back and forth on Futarchy all the time. Like, it's at the absolute core, it is the coolest thing we've seen on chain this cycle, in my opinion. But that does not mean it's not a really stupid idea. I don't know. It just seems like there can be so much convolution in that process, and like, does it make sense for really small decisions rather than, or like conceptually makes sense to me for really big decisions that actually drive a meaningful change in direction, which can ultimately impact value. But when we see these like smaller decisions, like it's getting used in grants programs, like, I don't know, it's pretty hard to judge the ROI of like a grants program, and it just seems like it'd be really hard to use it there. But I don't know, and it's empirically it's seeming kind of hard to pass things. They had the pump.fund competitor run through MetaDAO, and that got rejected, which is shocking to me. So I worry that it like over politicizes the governance process as well, which is ironic because it should be doing the complete opposite. But I don't know. At the bare minimum, it's super fucking cool.
It's super interesting. Yeah, and I agree with you. And I don't like the idea of linking the decision to a vote, like to a final outcome. But it's interesting when it's just information, right? Like, you have like Uniswap. You can buy Uniswap shares if the fee switch is approved, and buy shares if it's rejected. And then somebody can go to Uniswap governance and say, here's what the markets are saying, and that's it. Like that's the extent of it. I think when you start looping in the actual market outcome into the decision, you can get really wonky really fast. But as a source of information, I think it's awesome.
Agreed.
Yeah, I think it's cool as well. And I think it's kind of telling that new cool shit is being built on Solana and not on Ethereum, like I'm used to. Hopefully, we'll go back to Ethereum so that Daniel can stop talking about Solana.
Can hear the pain in your voice. My goodness.
Oh, man. Anyway, guys, Noah, Felipe, thank you so much for coming on. This was a pleasure.
Yeah, no, this is awesome, guys. Really appreciate you guys coming on, and we'll throw some links in the show notes to have the audience follow you guys and be able to see your great takes. Felipe, you're phenomenal on Twitter, so it's always a pleasure getting to chat with you.
Thank you. Likewise.
Cheers, Noah.
Take care.